Okay, so you know how the economy has been like a bit rocky lately?
Oh, yeah.
All this talk about marking volatility, it makes you wonder, right? It makes you think about like those legendary investors, the ones who have kind of weathered these economic storms and come out on top.
Definitely makes you think.
And I think there's no better example of that than Warren Buffett.
Oh, for sure.
So today we're going to dive into his investment philosophy.
I think that's perfect for right now. Uncertainty is in the air, and a grounded approach to investing is what everyone needs, you know?
It's timeless wisdom.
Absolutely, his principles, especially that focus on value investing.
Exactly, value investing. And to guide us through this, we're going to be looking at the book summary of Buffettology by Mary Buffett and David Clark.
Okay.
It's a great summary, really gets to the heart of Buffett's thinking. And our mission today, we're going to try to extract those core principles, those fundamental ideas that can help you, the listener, understand how to invest for long-term success. How about that?
Sounds like a plan.
All right, so let's start with something super fundamental. What are we actually doing when we buy a stock?
Okay, so this is where Buffett really challenges conventional thinking. And he says, don't just look at it like a ticker symbol, like something that jumps up and down on your screen.
Right.
Instead, the first step is to determine what business you want to actually own a piece of. And even more importantly, why you find that business appealing.
Like you want it?
Yeah.
I love that. It's about taking what the summary calls a business perspective.
Yes.
It's literally called Warren's winning way.
Right.
And it's for a reason. It's not about just looking at a stock chart and making a snap decision.
You got to dig in.
You got to dig in. You got to understand, how does the company make money? What are their prospects for the future? You know, what's their story?
Absolutely. And once you get that, then you move on to the next part of his philosophy, which is predictable and consistent earnings.
Okay.
And so he's not chasing after these companies that have a big spike in profit one quarter and then fall apart the next, you know?
Right.
Yeah, it's about those companies that demonstrate above average profitability, but they've got a history of maintaining that. And ideally, their outlook suggests they can keep it up.
Consistency.
Yeah.
Yeah. And it's interesting because a lot of people think value investing is just about finding a stock that seems cheap.
Yeah, that's like a big misconception. While a good price is definitely important, Buffett takes it a step further. He's really big on what they call the expected annual compounding rate of return.
Okay, so say that again, the expected annual what?
Yeah, it's the expected annual compounding rate of return. So it's not enough to say, okay, this stock looks undervalued right now. You have to try to project what that business is going to be worth in the future.
Crystal ball time.
Sort of, yeah. And then based on that, you calculate what your annual return would be.
If everything goes according to plan.
Right, if your projection holds up. And then he compares that rate of return to other investments he could make. The book actually gives this great example. They say, if a stock is at $10 now and you believe it'll be worth $50 in 10 years, well, that's a 17.46% annual return.
Wow.
Yeah. And if that projected rate hits his target, which is 15% or higher, then it aligns with his business sense approach to investing. And of course, this projection, it's based on assumptions about how the company will grow. It's not a guarantee. It's more of a measuring stick.
A benchmark to think about.
Well, right. Yeah.
So it's not about just today's bargain. It's about thinking about how this company will grow long term.
Exactly.
So this brings us to the types of businesses that Buffett tends to gravitate towards and his famously long holding periods.
Yeah. And one thing that stands out here is this emphasis on investing in businesses with excellent and consistent business economics.
Okay.
The summary goes into detail about the characteristics of such companies.
All right, let's hear it.
So they're talking about things like consistently high returns on equity, which is basically a measure of how profitable a company is relative to its shareholders' equity.
Okay.
He looks at that as an indicator of a well-managed and consistently profitable business.
Gotcha.
And they also mention strong and reliable earnings, what they call a consumer monopoly.
Ooh, a monopoly. Interesting.
And then also a management team that is working in the best interests of the shareholders.
Looking out for the owners.
Exactly.
So these aren't like flash-in-the-pan companies. They have staying power.
Yes, absolutely. And once he finds a business like that and the expected return looks good, his strategy is remarkably simple.
What is it?
Hold on to that stock long term.
Hold.
Hold. And that's key for letting that power of compounding really work its magic.
So explain that a little bit, the power of compounding, because it's kind of an abstract concept for some people.
Yeah, for sure. So the summary describes it as basically the best way to build wealth over time.
Okay, I like that.
It's like a snowball effect. Your initial investment makes money, and then that money starts to make more money.
It makes money on itself.
Exactly. And it just keeps growing.
So this is why that long-term view is so important.
Absolutely. And the summary even mentions the practical side of things, like limiting your transactions, because you want to avoid those taxes and fees that eat away at your returns over time.
Gotcha.
It's about letting time do the heavy lifting.
Patience is key.
Absolutely.
Okay, so this also kind of explains why Buffett prefers quality over chasing quick gains, right?
Yeah, the summary makes this point about holding on to a great business with a good return, say like 20%. It's a better strategy than going after a one-off 35% gain.
Because those are hard to find consistently, right?
Yeah, and on top of that, selling all the time, it triggers more taxes.
Right.
Plus, after you sell, you might jump back into something that's already overpriced. It's kind of like the tortoise and the hare. Slow and steady, it usually wins the race.
Consistency.
Yes.
All right, so we talked about this consumer monopoly.
Right.
The summary called it a sustainable competitive advantage. What does that actually look like? Like, what is an example of that?
So this is what separates the good from the great businesses. It's that special something.
Special sauce.
Exactly. The summary actually has this billion-dollar test.
Okay, I like these tests. Let's hear it.
They say, imagine you have $1 billion, right? You could hire the best management team in the world. Could you easily create a competitor that would threaten this business?
If you could, it's not that strong of a business.
Right, exactly. But if the answer is no, well, that's a good sign.
That means they got something special.
Yeah, it means they have a strong economic moat.
All right, moat, keeping the invaders out.
Yeah. And they also talk about these things called toll bridges.
Ooh, a toll bridge.
Yeah, so it's like essential services or products that other companies rely on.
So they have to use it.
They have to, and those make for really resilient investments. Think of it like the essential infrastructure, what keeps the economy running. And the summary breaks these excellent businesses down into 3 types. Companies that have these fast-wearing branded products that everybody buys, repetitive communication services, and then repetitive consumer services. The stuff people buy over and over again without even thinking.
Things you always need. Staples.
Yes, exactly.
Okay, so the summary also talks about Buffett's view on dividends, stock buybacks, acquisitions.
Right. And his approach is it's not about favoring one over the other. He always wants to do what makes the most sense for long-term value.
He's adaptable.
Yeah. So they say dividends make sense when a company can't reinvest its earnings at a high rate of return.
So they give some back to the owners.
Right. And stock buybacks, they become attractive when the company believes its stock is trading for way less than it's actually worth.
It's like they're getting a bargain on their own company.
Right. An acquisition only makes sense if you can buy another excellent business at a good price. So every decision, it all goes back to building value over the long haul.
I like that.
Yeah.
All right, so give us that checklist again of those excellent business characteristics, the things we should look for.
Okay, so according to the summary, they're often leaders in their industries. They don't have a lot of debt. They generate a lot of cash. They have a strong brand, low maintenance, and operating costs.
Makes sense.
Yeah, high quality products or services, consistently increasing book value, strong earnings, good management, and of course that durable consumer monopoly.
That sounds hard to find.
It is, and ideally a business doesn't need to constantly replace equipment, doesn't need to spend a ton on research and development, sells products that are always in demand, faces limited competition, and is led by a great team. Finding all of that is like finding a needle in a haystack, but that's what he looks for.
The ideal business. Okay, so there's this interesting shift that the summary talks about in Buffett's strategy.
Yeah.
He used to focus on these things called static value securities.
Right.
Basically, companies he thought were worth more if they were broken up, like liquidation plays.
Yes.
But then he shifted to these expanding value businesses.
Exactly. He went from trying to profit from a company's potential breakup to focusing on companies that have a lot of potential for growth. He realized that the real driver of long-term returns is consistent earnings growth.
Makes sense. So underpinning all this is this idea of the difference between price and value.
Right. Absolutely. And the summary really drives this point home. They say the price you pay is the single most important factor that will determine your future return.
So you got to look beyond just the sticker price.
Yeah, you have to understand what the business is truly worth, and that's different from the market price of the stock. That difference between your estimated intrinsic value and the price you pay, that's what they call the margin of safety.
Margin of safety.
Yeah.
So it protects you if you're wrong about something.
Exactly. Or if something unexpected happens.
Like a black swan event, right?
Yeah. So this long-term value-focused approach, it means he's not a big fan of market timing.
So no trying to time the market.
The summary actually quotes him on this, and it's one of his classic lines. He says, "Don't try to buy at the bottom and sell at the top. This can't be done except by liars."
I love that.
Yeah, it's basically a losing game, and he's not interested in that.
So what is he interested in? What's the main takeaway here?
Compounded value.
Compounded value.
That's at the heart of Buffett's value investing philosophy.
Okay, so break that down for us.
It's like a virtuous cycle. Your initial investment makes money, those earnings get reinvested, and the cycle repeats.
The snowball keeps rolling.
Exactly. And the summary even points out how this approach is similar to what you see with long-term equity mutual funds.
Interesting.
And then there's this idea of systematic investment plans, SIPs. It's a way that individual investors can benefit from this long-term compounding effect. Make regular investments over time, and it can really add up.
So it's like dollar cost averaging.
Yeah, sort of.
So we've covered a lot of ground here. What's the key message?
So the big thing is that investing like Warren Buffett isn't about getting rich quick. It's about understanding the businesses you're investing in and focusing on companies that have a lasting advantage, ones that are likely to grow their earnings consistently over time.
So it's about understanding businesses.
Yeah, and then buying at a reasonable price relative to their future potential, being patient, and letting the power of compounding do its work over many years.
The magic of compounding.
Exactly.
It's not about following the crowd or panicking when the market dips.
Right. It's about having a long-term mindset, thinking like a business owner.
Thinking like an owner.
Yeah.
And focusing on building wealth slowly and steadily through that compounding effect.
Absolutely.
And of course, having the discipline to stick with your plan.
Couldn't have said it better myself.
So our deep dive into Buffettology is all about informed, long-term thinking. But here's something to think about as you go about your day. As you see different businesses, start to look at them through this lens. Which ones seem to have a real consumer monopoly? Which ones strike you as essential toll bridges in the economy? You might be surprised by the insights you gain by just observing the business world around you.
It's all about training your mind to see the world like an investor.
Exactly.